Welcome back to the channel, guys. This is Jason, certified financial planner and host of Fighting Words Financial. Today I wanted to talk to you guys about the real estate market, what's going on with it, and why do I think that the real estate market is going to crash in 2021. Well, first of all, let me apologize for the sensationalist thumbnail. All thumbnails are a bit sensationalist now. I think that the market is going to decline in 2021. I don't think it's going to be a 2008, 2009 type crash. I just think there's going to be a lot more inventory in that time period, and let's talk about that right now. So I've been looking around YouTube and checking out some of the other guys that are talking about the real estate market, and a lot of them are talking about how great they think that real estate is going to do this year. And to be honest with you, I'm not really sure why they think that is the case. You know, the pandemic has absolutely destroyed local businesses, local small businesses. Main Street has been absolutely devastated. But the stock market is being propped up by the stimulus act at this point and all the liquidity that's been created. But the real estate market seems to be still very, very much stable. We've seen actual price increases to a degree, although that has started to decline at this point. So let's talk about the three factors that influence real estate prices. And there's really there's all kinds of other smaller factors that influence the price of real estate, but there's three really big ones. And those are interest rates, demand, and inventory. Interest rates right now are at all-time lows, and for the second time in my life, I'm actually saying this, that interest rates are at all-time lows for both the 15-year and 30-year mortgage. I think very briefly last week, you were actually able to get a 30-year mortgage at under 3% interest rates. Now, why is this important? This is important because it makes borrowing money very, very cheap. When you're trying to calculate your monthly mortgage, and that's how most people figure out how much house they can afford, is they calculate the monthly mortgage. The lower your interest rate is, the lower your monthly payment is, the higher price home you can afford to buy. So as interest rates rise, the amount of money that you borrow becomes more expensive, and it actually pushes down the amount of house that you can afford to buy because your payment is going to be higher at higher interest rates. Because these rates are at all-time lows right now, it means that the buying power of people who still qualify for a mortgage has been magnified. The second really big factor that influences housing prices is demand. Now, that is something we should talk about right now because demand patterns are changing. For years and years, real estate experts and economists have been telling us that the housing habits of younger generations like millennials have simply changed and the housing market is never going to be the same. Well, in the last 2 years, that has really proven to be not true. The millennials, in terms of their buying habits, are, in terms of real estate at least, they're just like prior generations. They were just delayed a little bit because of the Great Recession. Millennials are the largest generation around right now. They passed up baby boomers. They're also buying houses at rates now that resemble prior generations. They just started doing it a little bit later. Baby boomers are aging right now. They're not tending to move. They're tending to keep their houses off the market. So while they're keeping their houses off the market, there is increased demand from millennials who want to buy homes. But let's think about this. Baby boomers are going to start passing away at an ever-increasing rate simply due to age. Their houses will be coming on the market or they're going to be inherited by their millennial children. The third factor, and probably at this point the biggest factor in determining real estate prices and the reason why the market is being propped up and we haven't seen a crash in housing prices this year, is inventory. Inventory has been tight for a while, but check out this graph right here. This is a graph of delistings growth over time. If you notice, delistings started to accelerate way back in January, and they really got pretty high as far as April. So a lot of these houses were taken off of the market. These are houses that were for sale, that were taken off the market, and it further decreased inventory, meaning that there were buyers who still qualified and they were, who were very, very interested. The demand is still there, but now there's less and less inventory, and everyone feels like they have to compete against each other to secure a home. I think that inventory is going to start increasing here in the near future. I don't think it's going to be this giant increase or this flood of homes coming out of the market like it was in 2009. But I do think that over time we are going to see more and more houses, right? So now we already have seen this year a slight leveling off of home prices. And I think these numbers are going to continue to stay level, or they're going to slightly decline this year as more and more houses start to come on the market, which seems likely given current economic conditions. Home equity levels are dropping off. At the same time, unless the economy improves rapidly, unemployment is going to remain high, which is probably going to start leading to foreclosures or short sales, particularly when moratoriums are lifted and lenders start pursuing delinquent homeowners with federally insured mortgages. Now, let me be clear. When the moratorium does expire, right now it's currently in effect till August 31st. That looks like it's going to be extended probably at least into next year. When that moratorium finishes, there's going to be millions upon millions of homeowners that are simply not going to be able to catch back up to their payments. They're not going to be able to say, hey, I missed 12 payments, or 9 payments in the last 9 months or something. Now I owe $16,000 to the bank. A lot of those folks are just not simply going to be able to come up with that. They may be allowed to refinance their homes, but they probably won't be, because there's going to be a drop off in prices. They're going to have decreased home equity. They may be forced to go into foreclosure. But when you look at the bank's experiences with foreclosures and having a mass foreclosure market back in the 2008-2009 recession, they really didn't make a whole lot of money off of those deals. In fact, they lost money on those foreclosed homes. They don't want to foreclose on you. That's really one of their last options. I think we're going to see a lot more negotiated short sales in the future. I think it's probably a lot cheaper for the banks to keep you in your home, to negotiate some sort of payment and then a short sale over time, rather than you moving out, the house is empty, it starts to deteriorate. They don't have the people in place to manage all that inventory, or rent it out, or sell it, maintain it. They don't really want to take over all the maintenance of that home, so they're going to keep you in there. I think that we're going to see a lot more short sales beginning probably next year, which means there's going to be a large increase in inventory in the market. The next thing we should talk about is something that not a lot of people in the real estate market are talking about, and that's unemployment and how that is going to affect your ability to get a loan in the future. Right now, we don't really know how many people exactly are unemployed. It's somewhere between 20 and 40 million people as of July 29th, okay? So 20 to 40 million people are either missing their house payments, missing their rent payments, they're missing some sort of credit payment that's going to affect their credit rating at the 3 different credit rating agencies. That's going to affect how expensive it is to borrow money in the future. Now, yes, it's going to matter that interest rates are really, really low, and they're probably going to be low for quite some time. But many people who want to buy a home, many people who lost a job during this recession or this pandemic recession, they're going to go and apply for a loan. And if their period of unemployment and missed payments for any credit facilities doesn't automatically disqualify them for a loan, it is going to make it more expensive to borrow. They're not going to be getting that sub 3% rate. They're going to be paying a higher interest rate because they are perceived by the lender as a greater risk. This is, combined with the increased inventory that we're likely to see going into 2021, and the fact that many borrowers will not actually be able to take advantage of these historically low interest rates. I think that this is what causes downward pressure on home prices. There's simply going to be a lot more inventory, and it's going to be more expensive than people think it is going to be to borrow money. So those are my thoughts, folks. Tell me what you think in the comments below, and if you haven't subscribed to my channel already, please do so. Thank you very much, and I'll see you guys next time.